Hello everyone, I'm Josh O'Connell and this is episode 9 of Irish Tax Unwrapped. Whether you're a business owner, an investor or just curious, we break down Ireland's tax code for everyone. In this episode we answer the question, what do you get when you mix the land war, medieval tax loopholes and one poorly sequenced land transfer? Answer, a hefty tax bill and a crash course in agricultural relief. If you think this is too niche for you, the techniques and insights we will discuss hold true for any type of tax planning. Before we begin, a huge thank you to everyone downloading the pod. I have to give a special shout out to James, who asked, are the stories of tax woe about our clients? Nice one, James, but come on. Our clients don't fall into the traps we discuss here. If you're new here, please make sure to follow and share. You can find us on all major podcast platforms. Let's keep growing this community together. Welcome back, Derek and Daphne. So to start, what's new in the world of tax since we last spoke?
Hi Josh, we thought we'd start with a high-profile case that has sparked a lot of conversation in tax circles. Covidian is an Irish headquartered global healthcare products company and manufacturer of medical devices and supplies. It ran into difficulties with revenue and is facing a potential €46 million VAT refund liability.
By all accounts, the company had approached revenue in advance of incurring various costs for a steer on entitlement to VAT on those costs. Reports are that revenue indicated that VAT recovery would be due, but after incurring the costs, things began to unravel.
Revenue initiated an audit and Covidian is facing a VAT demand for €46 million.
What type of costs are we talking about?
Transaction support, advisory and internal group restructuring. These costs were linked to management services provided across the group and two major projects, one a global business spin-off and the other a corporate acquisition.
Revenue decided to have a hard look at whether the services received were directly related to taxable business activities. They said, some of this is shareholder stuff, it's non-economic, and a chunk of it, like the spin-off and acquisition work, wasn't linked tightly enough to VATable outputs.
So they said, nope, you're not getting it all back.
Revenue denied entitlement to over €45 million across multiple VAT periods. And their argument, Covidian could get partial recovery on some costs tied to management services, but for anything linked to the corporate restructuring or the acquisition, no recovery. They saw those as not meeting the direct use test under Irish tax law.
Which, let's face it, is where the tax trap starts. A lot of groups assume that because a holding company is involved in strategy or deal making, that automatically qualifies as economic activity. But the revenues line was, unless it feeds into taxable outputs, you don't get the deduction.
And Covidian fought back?
They did. They appealed the assessments to the Tax Appeals Commission. Their core argument was, we're not passive investors, we're engaged in real economic activity. The services were part of managing the group's operations and creating value, therefore the VAT is deductible.
They also leaned on something interesting, legitimate expectation. Covidian claimed that based on earlier interactions with revenue, they'd structured their VAT affairs on the assumption that recovery would be allowed. So they weren't just arguing technical points, they were also saying, you can't move the goalposts after the fact.
Right, so what did the Tax Appeals Commission say?
In a 172-page determination, the Commission sided mostly with Covidian.
They accepted that these costs had a direct and immediate link to Covidian's taxable activity and allowed the VAT deduction. That lined up with EU principles. They found that the company was engaged in economic activity. More importantly, they accepted that the input VAT costs had a direct and immediate link to taxable services, particularly those management services provided to subsidiaries.
While the Commission accepted that certain companies in the group were dormant or passive, they took the view that costs relating to management oversight were ultimately connected to an economic activity. This meant that VAT incurred on services, even those relating to acquisitions and restructurings, could be recovered.
So, if it was a win for the taxpayer, why are we still talking about this?
Because by then revenue had the bit between their teeth. They disagreed with the Commission's ruling and appealed it to the High Court. They lost at the High Court and then appealed again to the Court of Appeal, who overturned the Commission and the High Court and ruled in Revenue's favour.
In quite a stunning reversal, the Court of Appeal ruled that the law had been applied incorrectly by everyone. The test is not simply if a company is in business, ergo VAT deductibility on all costs, but whether the services bought in were used for making vatable supplies.
In plain speak, you can't just point to the group structure and say, sure, look at all this economic activity. You have to draw a direct line from inputs to outputs. The question of entitlement was reframed. What was the VAT incurred used for?
And what's especially tricky here is that a holding company often straddles economic and non-economic activity. You're managing subsidiaries, some of which are dormant or only hold shares, and others that trade actively. The VAT law doesn't give you a blanket pass. If you can't show how the service expenses supported actual vatable transactions, you're out of luck.
So this isn't just bad news for Covidian. It's bad news for every corporate group doing transactions in Ireland.
Potentially, yes. Legally, what has happened is that the Court of Appeal has reframed the legal question and returned the matter to the Tax Appeal Commission. Meanwhile, groups claiming VAT recovery on shared services, M&A work, legal costs, central strategy now need to reassess the scope of entitlement to VAT. The ability to demonstrate a link between costs and outputs just became a key factor.
What about the case being sent back to the Tax Appeals Commission? Any silver lining for Covidian?
There is a possible path forward. The Court of Appeal said Covidian can still argue that the services were overheads, that they formed part of the general costs of making vatable supplies. If that's proven, they might still get some recovery, but that argument needs to be made with far greater specificity this time round.
So what's the takeaway for everyone else? Because I'm guessing most finance teams haven't been this precise in tying costs to outputs.
The Covidian ruling is a wake-up call. Finance teams must reassess how centralised services and costs are linked to taxable outputs for VAT purposes. The days of vague justifications are over. Recovery now depends on clear, detailed documentation.
And this affects all companies, SMEs and multinationals. SMEs need to tread carefully to avoid losing entitlement to recovery on tax, legal and other consultancy services.
Moving on, Derek, off-air you mentioned a recent tax case that has implications for company directors. Can you share the details with our listeners?
Sure, Josh. This was a case involving a shareholder director who held a material interest, which means he owned more than 15% of his company. The business was liquidated years ago, but revenue came after him personally for unpaid POI and USC that the company had deducted from wages but never actually remitted.
So even though the company had shut down, revenue still went after him?
Yeah, tax law says if you're a director who owns more than 15% of the company, what we call a material interest, and the company deducts POI or USC but doesn't remit it, you don't get a credit for the POI deducted. And because you're liable to income tax on the gross amount, you effectively become personally liable for tax on wages which the company failed to pay over.
It's a way of ensuring that directors, especially those with real control, can't benefit from tax deductions that were never actually paid over. And in liquidation situations, this often gets overlooked until revenue knocks on the door years later.
And in this case, even though the director believed everything had been settled through the liquidation, the commissioner ruled that he was personally liable for the company debt.
Wow. How long after the company shut down are we talking about here?
Nearly a decade. The original tax years in question were 2012 and 2013. The hearing happened in 2022. So that gives you an idea of how far-reaching these liabilities can be and why directors shouldn't assume things are wrapped up when a company is wound up.
And the thing is, the director in this case genuinely believed the taxes had been dealt with during the liquidation. But because he had no documentation to say so, the liability landed squarely on his shoulders.
That must have been a shock. He thought it was over, but it clearly wasn't. So what stood out to you both as the most important takeaway for directors?
For me, it's this. When cash flow gets tight, it's tempting to delay paying over PAYE or USC to keep the business going, but if you're a director and the taxes are deducted but not paid, that liability can come back to bite you.
The director argued he made every effort to settle things. He even claimed an overpayment. But the law is black and white on this. Without proof the taxes were actually remitted, there's no wiggle room.
Let's clear up a common myth. If someone's a director, but not directly handling payroll, are they still liable?
Yes, if you hold a material interest, even if you're not processing payroll personally, you're still liable. That's what makes it so important for owner-directors to ensure compliance on the PAYE front.
So what should someone in that position do? Say, a director whose business is struggling right now?
A tax tip I would give is to prioritise paying PAYE over VAT.
There are strategies and options, but the longer you wait, the narrower those options get. Even in tough times, protecting yourself legally and financially has to be a priority. Take advice from a tax expert.
Right, and I know we had one more topic, but that's the news gong, and we have to move on. Let's take a short break, after which we'll turn our attention to the main subject of the pod, agricultural relief.
Running a business means making big decisions, and when it comes to taxes, those decisions can have a lasting impact. Whether you're navigating complex property transactions, planning a corporate restructuring, or optimizing shareholder remuneration, you need a strategy that works for you. At CoVenture Tax Consulting, we specialize in tax planning solutions tailored for businesses. Partner with CoVenture Tax Consulting and unlock tax strategies that align with your goals. Visit coventure.ie, your trusted partner in smarter business tax planning, to schedule a consultation.
So let's turn to the main subject of this pod, agricultural land and inheritance tax. A subject as old as the hills, you might say. Hey, imagine you're walking down Grafton Street early one morning. The air's still holding onto the last bit of damp. You nip into Bewley's, grab a coffee and a bun. Pick up a copy of the Irish Times on the way in. You skim the headlines, shake your head. Tariffs loom over exports. Government under fire for rent hikes. Controversy over land taxes again. The leader of the country saying there will be short-term pain for long-term gain. Sovereignty, they say. Fiscal independence. Business groups are warning of catastrophe. Farmers are furious. You'd swear it was this week, but it's not. It's Dublin, all right. In 1932. Back then, we'd just won back ownership of our land, at least on paper. The Brits, financed it all, and Irish farmers were left with massive loan repayments. De Valera came to power, looked at the books and said, hang on, we already own the land. Why are we still paying for it? So he pulled the plug on the repayments. And that kicked off what became known as the Economic War. It started in 1932 and dragged on for 7 years. Britain retaliated hard. They slapped tariffs on Irish agricultural exports, especially cattle, butter and bacon, which absolutely gutted rural incomes. Ireland hit back with duties on British coal and manufactured goods. What followed was a punishing tit-for-tat trade conflict that hit farmers the hardest. Fields full of unsold cattle, spiralling prices and political posturing on both sides. It was brutal. De Valera stuck to his guns, saying economic sovereignty was worth the pain. Sound familiar? But ask any farmer trying to feed his family during those years and you'd get a different view. After 7 years, the economic dispute was settled, land rates were quietly dropped and things could finally return to normal. And then, just when we thought we were finally free of foreign interference, who arrives on the scene? The taxman, looking to collect tax on inheritances.
When it came to avoiding inheritance tax, the elite had two powerful tools in their arsenal: fee tail and life interest arrangements, both rooted in feudal logic but still fully functional in 20th century Ireland.
These strategies were absolute fortresses against tax. They were using mechanisms designed back in the Middle Ages to outflank laws written in the 20th century.
All right, so let's talk about the fee tail. It's one of the oldest legal tricks in the land game, right?
Yeah, we're going all the way back to 1285, Statute of the Donis. This was a legal structure that let landowners effectively lock their property into the family line generation after generation.
Basically, if you created a fee tail, your land could only pass down to your direct descendants. You couldn't sell it, you couldn't split it, and you definitely couldn't lose it to the bookies. It was like putting the land in a legal straitjacket. It stayed in the bloodline unless and until the family line died out.
So we're talking proper Downton Abbey. Thanks for everything, love. But the land goes to the eldest son because tradition says so.
There were variations, but you get the gist.
So you have a highly convoluted ownership structure. It looks like yours, but it dies the moment the last direct heir of the original family line kicks the bucket. Until then, the land couldn't be sold or mortgaged or divided. It was a beautiful structure for tax planning. Land passed down like a royal title. In Ireland, this kept vast estates under elite control for centuries.
And the courts upheld it for far longer than you'd think. Cracks finally started to emerge after one famous case in Cork involving the McCarthy dynasty. Their land had been bound by a strict fee tale for over 200 years, but it all came to a head in the 1950s when the last male heir suddenly died. Details of the ancient structure hit the headlines, causing a right kerfuffle.
Sounds like a big tax time bomb.
For centuries, fee tale arrangements worked as powerful estate planning tools for the wealthy, but fast forward to the 20th century and they were a tax trap.
So that's when the system starts wobbling.
Exactly. In 1959, fee tale was abolished in Ireland. That was the first major breach in the wall. No more guaranteed dynastic succession, but the big landowners weren't out of tricks yet.
Oh no, they just pivoted straight into life interest transfers, which, if anything, were sneakier.
Go on.
So you transfer legal ownership of the estate to your heir before you die, but you retain a life interest. You still live on the land, collect the income, call the shots basically. Technically, you no longer own it. So, surprise, no inheritance tax.
So on paper you've handed it over, but in reality you're still king of the castle.
Yes, one of the most famous examples was Lord Kilbride in Kildare. In 1968, he transferred legal ownership of the family estate to his eldest son, held on to it in a life interest, and died in 1974. The family thought they'd dodged the tax entirely.
Spoiler alert, they didn't. Revenue caught on. That case blew up and ultimately led to the clampdown of 1976.
So what happened in 76? Was it a full-blown legislative hit job?
You could call it that. There was mounting political pressure. Ordinary families were getting hammered with inheritance taxes, while aristocratic estates were being ring-fenced from any liability. The government stepped in to level the playing field. Two major reforms sealed the deal. First, life interest transfers became fully taxable upon the original owner's death, so families couldn't just pass property on paper and escape tax. Second, if someone transferred land in anticipation of death, the tax law treated it like a regular inheritance.
Yep, no more last-minute dodging. Wealthy landowners suddenly had to rethink their estate plans because the old tricks weren't working anymore.
Interesting. What happened next?
Well, Josh, once the 1976 clampdown landed, it created a whole new kind of pressure. Not just legal or financial, but political. Revenue had shut down the old planning tricks, but the fallout was being felt hardest by small to medium farmers. These weren't dynastic landowners dodging tax. These were ordinary families trying to keep the farm in the bloodline.
And they were getting walloped. You had cases where sons and daughters inherited the family farm and were suddenly on the hook for massive tax bills. No liquidity, no exemption, no mercy. So yeah, people started getting vocal. The Irish Farmers Association stepped in, hard.
Right, the IFA, along with other rural lobby groups, began campaigning seriously. They argued that the tax law as it stood was anti-farming. They weren't wrong. It was treating long-term productive assets like speculative wealth, and that triggered real political heat, especially in rural constituencies.
TDs were getting earfuls at every constituency clinic. You had Fianna Fáil talking about protecting the family farm, Fine Gael pushing for fairness in succession. Eventually, the Department of Finance couldn't ignore it. The law was unintentionally breaking up generational farms, and politically, that was radioactive.
So you're saying the tax law tried to catch the lords in the big houses, but ended up crushing lads with a few cows in Roscommon?
You've hit the nail on the head. There was no carve-out for working farms, no recognition of intent or use, and that's what finally forced the state's hand.
And out of that pressure cooker, agricultural relief was born, a way to distinguish between inherited wealth and inherited work.
All right, let's talk about agricultural relief, because nothing says light morning chat like 6-year clawback periods and valuation dates, right? Now, Derek, what's agricultural relief?
Agricultural relief is one of the most significant tax reliefs available for farming families. At its core, it reduces the taxable value of qualifying agricultural property by 90%. So if you're inheriting or receiving a gift of a farm, you could be taxed on just 10% of its value.
That's a big discount. So what's the catch, Daphne? There's always a catch.
Oh, several. The big one is the farmer test, which has 2 parts. You need to pass both an asset test and an activity test. First, at least 80% of your assets must be agricultural after the inheritance or gift. Second, you need to either farm the land yourself commercially or lease it to someone who does. And whoever is doing the farming must have a green cert.
I've seen headlines recently about farms being misused for tax. What's that about?
There's been growing concern around tax avoidance, wealthy people selling investment assets, buying farms instead, as vehicles to avoid tax.
Jeremy Clarkson comes to mind.
So the rules are tightening. One change, likely next year, is extending the active farmer requirement to the disponer. That's the person giving the land. Right now, the tests only focus on the recipient.
Hang on, so you're saying the person gifting the farm will also need to prove they farmed it?
Correct. Or that they leased it to somebody who did, for 6 years prior to the transfer.
That's got a sting for some families, especially the ones holding land purely for value.
Precisely. It'll force a change in planning. And it's not just that. Previously, you could make a cash gift on the condition of the recipient buying farmland, investing, say, within the next 2 years, and qualifying for relief. That's also earmarked for removal.
That one slipped in quietly, actually, but it's a big deal. It cuts off a pretty useful planning route. We used to have clients gift cash, then grab a few acres to meet the test. That's out the window if this goes through.
Let me ask about clawbacks. You mentioned 6 years. What are we looking at if things go sideways?
The relief is clawed back if within 6 years the land is no longer used for farming, or if you flunk the farmer test post-transfer.
All right, so if you're inheriting the land, what counts as agricultural property? Can I sneak in a vintage tractor collection?
Tractors, livestock, even farm buildings, they all qualify if they're on agricultural land.
And farmhouses, obviously they qualify?
Don't get me started on farmhouses. Every year we see people trying to claim relief on their cousin's old bungalow 5 miles from the farm. Revenue isn't buying it unless the house is integrated with the farm and actually used for farming.
What about small parcels of land?
There's no hard rule, but revenue challenges anything under 2 acres by default. And as always, you need real farming activity.
Let's touch on solar panels. I heard something about land being used for them still qualifying.
Yes, since 2017, land with solar panels can qualify for relief as long as those panels don't cover more than half the land area in the inheritance. But keep documentation, maps, plans, surveys. Revenue loves a good map.
You mentioned something about a green cert. I imagine it's not just an online course and a quiz.
Definitely not. It's a full agricultural qualification, typically 2 years of study, and you must have it to meet the activity requirement, unless you plan to lease the land out. Even then, the lessee has to meet the same standards. A key planning point, unqualified beneficiaries can still qualify if they obtain the cert within 4 years.
Also, your lease agreement should include clauses about meeting those tax conditions. You don't want your tenant torpedoing your tax position because they decided to become a part-time beekeeper instead.
So what's the final word here? What's your recommendation for someone dealing with this right now?
If you're planning to transfer agricultural assets, whether by gift or inheritance, get advice well in advance. Check both the giver and the receiver meet the various tests, document everything, leases, farming activity, valuations, and assume revenue will come looking for the paperwork.
And be realistic. If you don't qualify now, you might be able to restructure assets, transfer non-agricultural wealth elsewhere, or bring in a qualifying tenant. But don't wait until after the fact. Tax traps love procrastinators.
Now that's the big picture, the rules, the relief, and the traps that come with it. But let's put that theory to the test. Can we look at a real case which highlights some of the difficulties that a person can run into in practice? Let me guess, she ends up with a big tax bill. What went wrong?
There's a well-known tax case which highlights almost everything that could go wrong in practice. A daughter got a gift of land from her parents, and then later that same day, she's also given the house built on it. She needed to pass the farmer test and would if she receives agricultural land first and residential land second. Sounds straightforward, right?
Let me guess, she ends up with a big tax bill. What went wrong?
Lots of things went wrong in this case. She received multiple gifts from her parents on the same date, 2 parcels of agricultural land and 1 of residential property. Her argument was that she got the agricultural land first, meaning she checked the box on being a farmer for agricultural relief, and later the same day received the residential property. As far as she was concerned, she met the conditions.
She was relying heavily on how the transfers were planned. There were detailed email instructions to the solicitors laying out the sequencing: land first, residential after. The instructions referenced putting daylight between the transactions to protect against any problem. But above all, the instructions were crystal clear: transfer the land first to meet the farmer test.
Okay, so she's not winging it. She's got paperwork, strategy. She's following advice. What went off the rails?
Execution. The Revenue Commissioners challenged the paperwork and took the view that all gifts received on the same day must be looked at collectively.
That's important. Her contention that she was a farmer after getting the land doesn't fly if Revenue treats the house as having been received at the same time. She flunks the asset test, which she must pass to be deemed a farmer for the relief.
Hold on. Was there any proof the land was actually received first?
That was one of the central disputes. Her solicitor testified that he intended to follow the sequencing laid out in her email, land before residential.
Oh no.
He said the agricultural land deeds were signed first, but he also admitted to being away on holiday when some of the timing decisions were made. He couldn't confirm the exact order of delivery or stamping.
Oh dear, oh dear.
The whole thing was a bit of a mess administratively. Some of the deeds were executed weeks later, some were stamped on different dates, and in one case the solicitor said he didn't have PPS numbers on hand to file the necessary paperwork. The client gave precise instructions, but they just were not followed.
But hang on. Didn't her solicitor testify that the deeds for the land were signed first?
He did, but there was no contemporaneous evidence showing a legal delivery occurred in that order. The solicitor even admitted that the documents were all handled without formal structure. He physically picked them up, but couldn't confirm which were delivered or accepted first.
Also, she had filed a professional negligence claim against her solicitor, basically for failing to ensure that the transfers happened in the right sequence. It's unhelpful if you're asserting something in one forum and the opposite in another.
What about her father? Did he give evidence and did it sway the case?
He did. He said the whole point was to get the agricultural land over first so that his daughter would meet the farmer test before receiving the residential property. He even made a diary note saying, farms first, houses last.
So her net argument was about what her intentions and instructions were. She says, I did everything to show I got the land first. Revenue says, we don't care what you intended to do. We look at what you actually did.
And that was the legal issue. Do you assess the farmer condition at a specific moment based on what the client wanted, or do you assess the case based on the paperwork, even if the implementation is sloppy, but it's not the fault of the client?
You won't be surprised that Revenue's argument is that it's the paperwork that determines the outcome. And if this says you get gifts on the same day, they're assessed together.
So, bottom
Josh,
line,
if you think
the
this
intention
through,
was clear, the
planning
planning
ahead
was
really
deliberate,
matters.
but the actual
If
legal
someone's
steps
thinking about
weren't
passing
tight
down
enough.
growth shares,
Yes,
they should
the
really
Commissioner
get started
found
early.
that because all the deeds were executed on the same day and there was no firm proof that one gift became effective before the other, they had to treat them as having occurred contemporaneously.
Taking that approach, the residential property had to be included in the farmer test, which she failed. And the Commissioner made a broader point as well. Even if you argue sequencing, You need more than just email instructions. You need execution logs, timestamps, clear delivery moments, all of that sort of thing.
There were other sloppy details. There was a farmhouse involved, and she hadn't been advised that it could qualify for relief. So not only did the sequencing unravel, but there was also confusion about what actually counted as agricultural land.
Was that farmhouse ultimately accepted as agricultural?
While evidence showed that it was used to support farming operations, had farm access, storage, administration functions, ultimately it didn't. The sequencing issues sank the claim.
So she ends up with no relief and a substantial tax bill. What, 30 grand?
30 grand plus a surcharge plus costs. And if her liability came to around 50 grand in total, you have to remember that this becomes 100 grand when you consider that she has to earn the money to settle these costs.
That's bad. So, while agricultural relief may seem straightforward on the surface, it turns out that navigating the relief is quite complex in practice.
If you're planning to rely on any tax relief, you have to plan and execute the relevant steps carefully. Don't assume that others will blindly follow your instructions, but at the same time, any tax expert worth his or her salt will want to oversee implementation. They won't just leave it to the solicitor. They'll work hand in hand to ensure that all the relevant paperwork is executed in the correct order.
Now, we've just got enough time to squeeze in our new segment, the 1-minute tax relief spotlight. This week, our man behind the scenes, Rory, is going to explain special needs trusts. Over to you, Rory.
Listener, as you probably know, families with children or adults who have disabilities often face a unique and complex set of challenges, not just in daily care, but in long-term financial planning. A common issue we see is when a well-meaning parent names their child directly in a will without realizing that doing so can actually cause harm. If the person can't manage money or lacks mental capacity, a direct inheritance can leave them exposed, or worse, result in the loss of vital means-tested support like housing or care. This is where special needs or special interest trusts come in. These are legal structures that allow money to be set aside for a vulnerable person without putting it in their hands. Trustees manage the funds in their best interest, protecting them both financially and legally. Setting one up isn't about wealth, it's about ensuring continuity of care, stability, and dignity. The first step is often simply acknowledging that standard wills aren't built for every family. From there, speaking to a tax expert with experience in this area can make a crucial difference. It's one of the most overlooked areas of planning, and one of the most important. If you or someone you love could be affected, don't wait. The right structure, set up early, can safeguard their future when it matters most.
Thanks for tuning in to another episode of Irish Tax Unwrapped. We hope today's conversation was as stimulating as a freshly brewed Bewley's coffee. Today, we peeled back the layers of agricultural relief, showing just how much is at stake when it comes to transferring property. What seemed like a simple tax break quickly revealed itself to be a labyrinth of rules, timelines, and paperwork that can trip up even the most well-intentioned. As always, it's not just about following the law, it's about getting the details right. If you have any questions or topics you'd like us to cover, feel free to reach out. Until next time, keep your finances in check and your tax knowledge sharp.
If you enjoy Irish Tax Unwrapped, please rate, subscribe, and share the podcast. If you've any questions or topics you'd like us to cover, please contact the show on X @TaxUnwrapped or email the show podcast@taxiq.ie.